The crypto market is crashing. At the time of shooting this video, BTC is down by more than 15% from its recent highs, and most altcoins are down by high double digits.
Why?
This has everyone wondering why the crypto market is crashing, how much lower it could go, when it could start to recover, and just how high it could go when it does. Today's video has all the answers. This is one you want to watch until the end. Okay, let's start with why the crypto market is crashing. As you can see, the crash began shortly after BTC hit an all-time high of almost 74k last week. The initial correction was not surprising, as BTC has recently had a habit of seeing a small pullback after hitting a new all-time high, mostly due to long liquidations. For context, long liquidations happen when BTC traders bet that its price will go higher, but it goes lower instead. The practical effect of this is that it forces them to sell the BTC they had borrowed to make that bet, which causes BTC's price to fall sharply. This causes more liquidations, and so on and so forth. Now, what was surprising, though, was that this time around, BTC continued to go lower. Logically, this suggests that there was some additional catalyst for the continuation, not just liquidations from irresponsible traders. For reference, there are two catalysts that affect crypto prices: crypto-specific factors and macro factors. Crypto-specific factors include things like the approval of the spot Bitcoin ETFs earlier this year, which sent BTC and some altcoins to new all-time highs. Macro factors, meanwhile, include things such as lower interest rates, which the Federal Reserve signaled were coming last December, likewise sending stocks to new all-time highs. Now, to understand whether it's a crypto-specific factor or a macro factor that's affecting crypto prices, all you must do is compare BTC's price to that of major stock indices like the S&P 500 and the Nasdaq. If the price action looks the same, it's probably a macro factor. If it looks different, then it's a crypto factor. Here is where things get interesting. The S&P 500 hit a local top on the same day that BTC hit a new all-time high last week. The official story is that the subsequent crash in both was due to two back-to-back inflation readings in the US, the CPI and the PPI, which came in higher than investors were expecting. For those unfamiliar, higher inflation readings increase the risk that the Fed will keep interest rates higher for longer. The practical effect of this is that it's harder to borrow money, which is negative for the economy and the stock market. Today's prices often reflect what investors believe the Fed will do next. Now, there's just one small problem with the official story about high inflation readings causing stocks and crypto to crash. That's that the S&P 500 and BTC both hit their local highs on the same day as the CPI print. If inflation and interest rates were the real reasons, both would have crashed, not rallied. The answer to this mystery seems to lie in something that very few traders and investors think about, and that's passive flows. Basically, most of the price action in the stock market is driven by automated buying and selling by pension funds and the like. In the absence of any big surprises, they always buy. And this is where the significance of the spot Bitcoin ETFs becomes apparent. What they fundamentally did was make it possible for BTC to be a recipient of the passive flows we see in stocks. This is why BTC and stocks have essentially been going up only for months, and why this trend could continue after this crash. But again, this begs the question of why the crash happened. Well, by now you should have an idea of what the real answer is. In short, most of the passive flows into stocks and BTC stopped. According to macro analyst Chem Carson, this is a cyclical phenomenon that has nothing to do with inflation or interest rates. Now, naturally, this begs the bigger question of when these passive flows will come back and resume pushing BTC and stocks higher. The answer seems to be sometime in the next few weeks, at least according to Chem. Between now and then, though, both asset classes could head much lower than investors expect. It's also possible that we'll see another big leg lower in the second quarter. More on that in a second. And by the way, if you're enjoying the video so far, be sure to smash that like button to help others find it, and subscribe to the channel and ping that notification bell so you find our next video. So, now that we know why the crypto market is crashing, we can address the question of how much lower it could go. The answer here ultimately depends on your time frame. In the short term, it's possible we'll see a recovery rally as traders and investors buy the dip. This is where technical analysis comes in handy, specifically the Bollinger Band indicator. As you can see, BTC tends to rally up to the Bollinger Band moving average after a big correction. This is true across most timeframes, but in this case, we're looking at the 4-hour and daily chart for short-term analysis. Zooming out to the daily reveals that BTC could experience a recovery rally to around 67k in the short term, which would translate to a comfy 6% gain from current prices. Most altcoins would likely gain 12% or more, since they tend to be about twice as volatile as BTC, in both directions. Assuming this occurs, then there are two possibilities. The first is that BTC gets back above the Bollinger Band moving average on the daily and continues to rally. The second is that BTC gets rejected by the Bollinger Band moving average on the daily and continues to head lower. Given that the passive flows that have been propping up BTC and other assets apparently won't be around for another few weeks, it's therefore safe to assume that the downside scenario is more likely. The catalyst for this downside scenario could very well be something said by the Fed today. FYI, the Fed will be announcing its interest rate decision in the next few hours and releasing its updated projections for where it sees interest rates headed later this year. Depending on when you see this video, this information could have already come out. You'll know if it's bullish or bearish based on BTC's reaction. Come to think of it, the Fed press conference being bullish could very well be the catalyst that takes BTC back up to the Bollinger Band moving average on the daily. Of course, it's also possible that it could get a boost from crypto-specific factors, such as large institutions announcing that they will buy the Bitcoin ETFs. However, if we don't get any bullish crypto catalysts, and if the Fed's decisions are perceived as bearish by investors, then BTC could fall to the Bollinger Band moving average on the weekly, which currently sits at around 47k. Now, it's important to note that these large corrections can occur during big bull markets. And if you want to trade these short and medium-term moves, then be sure to check out the CoinBureau deals page. It's got trading fee discounts of up to 60% and sign-up bonuses of up to $60,000 on the best crypto exchanges. These deals are only available to CoinBureau viewers, and they won't be around for long, so take advantage of them ASAP using the link in the description. But this is just how low BTC could go in the short term. In the medium term, i.e. Q2, BTC could see a much bigger correction. To be clear, this doesn't mean that BTC would go down only. As I mentioned a few moments ago, there would be recovery rallies along the way, and some of these could be quite large. As with the shorter-term correction, though, there would need to be some catalyst that triggers another leg lower in the next 3 months. Funnily enough, there seems to be one that's analogous to the lower passive flows that caused the recent crash, and that's liquidity, the amount of money in the economy. Now, as you can imagine, measuring the amount of money in the economy isn't easy. One of the few who's been able to do it accurately is macro analyst Michael Howell. Similarly to Cem, Michael's core thesis is that flows fundamentally determine price action. The difference is that he looks at flows from central banks and governments, whereas Cem is more focused on passive flows from market participants. Believe it or not, but Michael's focus on liquidity makes it possible to time the BTC bottom in late 2022. Now, obviously, there were other crypto-specific factors at the time that caused BTC to crash, notably the FTX collapse, but liquidity played a big role as well. In fact, Michael believes that BTC is hypersensitive to liquidity. That's why his prediction that liquidity will see a slight decline in Q2 is so significant. It foreshadows a much deeper correction in BTC and stocks than investors are expecting. This decline in liquidity is due to a combination of factors, including tax season in the US and elsewhere. The catch, though, is that Michael's research suggests that BTC lags liquidity by about 6 weeks, meaning that the impacts of the liquidity drain won't be felt until later in the quarter, specifically late May or early June. At that point, it's possible that BTC could test the Bollinger Band moving average on the monthly. Consider that the Bollinger Band moving average is currently around 31k. By May or June, though, it will probably rise somewhere closer to 40k. Regardless, it would be a sizable correction that, in Michael's estimation, wouldn't last long, as liquidity will start rising in Q3 and continue rising until late 2025. This ties into the question of when the crypto market will start to recover. Again, the answer ultimately depends on your time frame. I'll start by reminding you that BTC and most altcoins are likely to experience sizable recovery rallies even if they continue to head lower in the short to medium term. I'll also remind you that the liquidity trends identified by Michael may not affect crypto prices until the summer, and that the flow trends identified by Chem are likely to resume between now and then. It goes without saying that you need to keep all the other macro and crypto factors in mind too. When you put all of these factors together, you get a very mixed picture for when the crypto market could recover in the short term. For example, the passive flows could come back, but we could get a bearish crypto catalyst like another SEC crackdown that causes crypto, and particularly altcoins, to stay stagnant. On the flip side, the passive flows that could have been spooked by the recent crash and reduced their exposure to the spot Bitcoin ETFs could then hear that the judge has thrown out the SEC's case against Coinbase, for instance. This would be extremely bullish for altcoins and have a neutral to positive effect on BTC. Another factor that would be extremely bullish for altcoins would be a spot Ethereum ETF approval, which could happen by May. Unfortunately, though, it's looking less and less likely that this approval is in fact coming. Fortunately, it seems that this is already priced in. Remember, investors are always forward-looking. Now, the caveat is that these are all factors we can't predict with any certainty. Thankfully, there are two that we know will come no matter what. The first is the Bitcoin halving. It's currently expected to occur around the 20th of April, and it could be bullish for BTC and the rest of the crypto market, depending on the ETF flows. If the spot Bitcoin ETF flows are high before and after the halving, the restriction in the amount of new BTC being issued could supercharge its price. Conversely, if the flows are low and BTC's price is still lagging, this could put many Bitcoin miners out of business and potentially drag BTC's price lower. Now, the second factor we know will happen is the Fed's next press conference, which will likewise occur at the end of April. Depending on how the economic data looks coming into that conference, it could be bullish because investors are expecting a rate cut, or bearish because they're expecting the status quo. In any case, the key takeaway is that the crypto market will likely only start to recover in response to a bullish macro or crypto catalyst. As you might have gathered, there's no shortage of these, but their effects on the crypto market may not be clear-cut. There are also lots of bearish catalysts lurking around too. But that's just in the short term. In the longer term, the passive flows and the liquidity seem to guarantee that the crypto market will start to recover sometime over the summer. It's believed that the Fed and the Treasury will also try to juice the markets as much as possible leading up to the November election. On that note, you may have heard that market returns tend to be higher during election years. What's fascinating is that Chem found that these returns have been the highest during times of populism and contested elections, which is effectively what we had back in 2020, and what we will have again this year. To put things into perspective, the average stock market return during a US election year is around 11% versus the average of around 7% in a non-election year. However, populist and contested elections make up the chunk of the election-related returns, yielding over 20% each on average. When you factor those elections out, average stock returns are actually closer to 5% during election years. The more you know. Anyway, fun facts aside, The fact of the matter is that BTC and altcoins will likely end the year much higher than their recent prices. This means new all-time highs for BTC that could be closer to 100k and all-time highs for most altcoins, not just meme coins. 2025 is when prices could truly go parabolic, though. Besides the fact that there will be more political certainty in the US and perhaps geopolitical certainty by extension, it's very likely that most central banks will be cutting interest rates by the time 2025 rolls around. At the same time, they will be legally allowed to hold crypto on their balance sheets. Speaking of which, whistleblower Edward Snowden recently made a bold prediction that another country besides El Salvador will announce that it's been accumulating BTC later this year. It's safe to say that Edward might know something we don't, given that he spent his early career in US intelligence. Meanwhile, the Swiss central bank once remarked that it could consider holding BTC on its balance sheet in the future. This kind of announcement could be the catalyst for a blow-off top in BTC. Historical cycles suggest the blow-off top could happen between the spring and summer of next year. So, this brings me to the biggest question of them all, and that's how high BTC and altcoins could go once they recover and continue going up only. I'll start by saying that there's no shortage of price predictions out there, and that nobody at the Coin Bureau has a crystal ball. At least, not to my knowledge. That said, if you watched our last crypto market update, you'll know that BTC's all-time high could range between 120 and 200k, depending on whether you buy into the idea that all the money printing during the pandemic has inflated the value of BTC and most assets by 40% relative to previous cycles. If you don't buy the inflation-adjusted idea, then the diminishing returns we've seen over BTC's previous cycles suggest that it would hit between 120 and 140k. If you do buy the inflation-adjusted idea, then BTC's cycle top could be between 180 and 200k. Again, it's impossible to predict this with 100% accuracy. It also makes assessing altcoin cycle tops much more difficult. For instance, ETH's historical performance suggests its cycle top could be somewhere between 15 and 20k. This assumes that ETH is following BTC one cycle behind, which would make sense given that it's been subject to the same catalysts, ETFs, etc. On the inflation-adjusted basis, however, ETH's cycle top could be between 21 and 28k. Note that you can do this calculation yourself for most of the other altcoins. Take what you believe to be the most likely top and add 40% to it, as that's the amount of new money that was created during the pandemic. I'll use Sol as another example to help you out. It's possible that Sol is following ETH one cycle behind, in which case Sol's cycle top would be between $1,000 and $1,200. Adding 40% to that range gives you a range of $1,400 to $1,700 for Sol, which would be much higher than most investors expect. Now, from our perspective, it seems more likely than not that the crypto market will surprise to the upside, regardless of inflation adjustments. That's because this crypto market cycle is the first one where institutional capital can easily flow into the market. It will likely be the biggest one we've seen so far. Just remember that a downturn will come eventually, and when it does, the outflows will be just as large. You can rest assured that we will do another urgent crypto market update when that day comes. With a bit of luck, though, the next one we do will be because of bullish market conditions. Fingers crossed, eh? And that's all for today's video, folks. So if you found it helpful, be sure to smash that like button. If you want to keep getting helpful crypto content, be sure to subscribe to the channel and ping that notification bell. And if you want to help others understand why the market is crashing, share this video with them. As always, thank you so much for watching, and I'll see you in the next one. This is Guy, signing off.